I've worked in the financial sector for over 20 years. Specifically, I deal in the areas of personal finance, individual and business taxation, as well as helping people manage their IRS or state tax debt. Because of this, I get to see a lot surrounding money. And you want to know one interesting thing that I've learned over the years is that the banks, in dealing in money, tend to make a ton of money in doing it. But if I may ask, at whose expense? I'll give you a hint. But it doesn't have to be that way. In this episode, we're going to talk about how poor money habits equal profits for the big banks. We'll also talk about what you can do to keep more of your wealth in your pocket and out of the hands of those fat cat bankers. Let's go. Hey friends, it's Jared Rogers CPA here, back with another episode of Minding My Money Mondays, a common sense talk about money matters. If you're new to the channel and never want to miss another money saving tip, simply hit that little cartoon dude in the lower right side of your screen to subscribe. Also, make sure you click the little bell icon. That way you'll receive notifications every time a new video is posted. So have you ever wondered how banks make their money? I mean, how do you make money off of simply dealing with money? Seems kind of weird, right? Well, let's look at how it all works. The first place we have to start is with what type of customers use a bank. Bank customers usually fall into a few categories. These include retail banking. Retail banking is what most people think of when they hear the term personal or private banking. Retail banking primarily offers services to individuals surrounding deposits, access to loans, and other related financial services. Commercial or institutional banking. Commercial banking involves making loans to businesses. This lending enables businesses to grow and hire people, which in turn contributes to the expansion of the economy. Institutional banking is the banking that banks do with one another or with other banks and other large non-traditional lenders such as insurance companies and the Federal Reserve or the Fed. Investment banking. Investment banking focuses on the creation of stocks and bonds. In the US, this was traditionally limited to the stock brokerages, but all that changed with the repeal of the Glass-Steagall Act back in 1999. In this video, we're going to only focus on the area where banks make money from people like you and I, and that would be retail banking. In retail banking, the bank makes its money primarily through three areas. These are lending activity, fees, and what is known as interchange. Let's start with lending. When customers make deposits into banks, the bank typically uses most of those deposits to provide loans to other customers. These loans, such as home and auto loans and student loans, all have interest rates tied to them. And these interest rates are what the customers need to pay the bank in order to get the loan in the first place. For the bank, the money earned on these loans is revenue to them. And some of that earned money is given back to customers in the form of interest, within checking and savings accounts. The money that the bank keeps, or the difference between how much the bank earns on their loans versus what they pay back to the customers, well, that's their profit. Next up are fees. Yes, banks make a lot of money from charging borrowers interest, but the fees banks charge are just as lucrative. Most people are familiar with banking fees, but let's go over some of them in detail, shall we? Account fees. Some typical financial products that charge account fees are checking accounts, investment accounts, and credit cards. These fees are said to be for maintenance purposes, even though maintaining these accounts costs banks relatively little to do. ATM fees. There will be times when you can't find your bank's ATM and you must settle for another ATM just to get some cash. Well, that's probably going to cost you between $2 to $3 every time you do it. Situations like this happen all the time, and it just means more money for the banks. Penalty charges. Banks love to slap on a penalty fee for a customer's misfortune. It could be a credit card payment that you sent at 5:01 p.m. when it was due at 5 o'clock. It could be a check written for an amount that was 1 penny over what you had in your checking account at the time that it posted. Whatever it may be, expect to pay a late fee or that notorious overdraft fee between $25 to $40. It sucks for customers, but the banks don't care because it's more money for them. Application fees. Whenever a borrower applies for a loan, especially a home loan, many banks charge a loan origination or application fee. On top of that, they can take the liberty of including that amount of the fee into the principal of your loan. This means that you not only are paying the fee, but you are paying interest on it too. The last area banks make money on is what is known as interchange. Whenever you use a credit or debit card to buy something at a store, the store usually has to pay what's known as an interchange fee. Most of the interchange fee goes to your bank, but some goes to the store's bank. This interchange fee covers the cost of handling credit and debit transactions. Interchange fee rates are set by the credit card companies. Among other factors, interchange rate fees can vary from one provider, but the way in which they are structured is that they're a percentage of the transaction plus a flat fee. The more expensive the transaction, the more the interchange fee. When you go into a store or restaurant and you see that there is a card minimum, it's most likely because of the interchange fee. The flat rate portions of the interchange fee for smaller transactions can really add up for a business. So what do? They either set a credit card minimum or they simply pass that fee on to you. So now that we know how the banks make their money from you and I, let's look at how poor money habits equal big profits for the banks. The first way you can give excess money to the banks is by having a poor credit score. When your credit score isn't ideal, you'll wind up paying more for the products you want to buy via a higher interest rate. Let's say you have two people that want to get a car loan from a bank. One person has an 800 plus credit score, like say, me. But the other person has a 600 credit score. The amount of the vehicle loan is $25,000 and it has a term of 6 years or 72 months. Well, the person with the 800 credit score has a monthly payment of $402.62. They'll pay the bank $28,989 over the course of 72 months, and the bank will get $3,989 of interest or revenue for making the loan. The person with the 600 credit score has a monthly payment of $438.33. This is only $35.71 more per month than the person with the 800 credit score. But over the life of the loan, they'll pay the bank $31,560 and give them $6,560 in interest. That's $2,571 more dollars than the person with the 800 credit score, all because their credit score isn't ideal by banking standards. The second way you can give excess money to the banks is by not actively managing your money, payment, or purchasing decisions. So, this can happen, for instance, when you pay unnecessary ATM fees for pulling money out on the fly at the ATM of another bank because you didn't plan. Say you take $50 out of a non-bank ATM and the fee is $3. That's 6% cost of getting your own money back from the bank. Excess money can also be given to the bank by not maintaining enough money in your bank account and getting hit with minimum deposit fees, or by paying the bank an overdraft or early withdrawal penalties because you are forced to take your money out in an emergency because you don't have a rainy day fund, or by financing purchase with high interest rate credit cards, or by businesses not managing their money and debt load and paying tons of interest. Like I said at the beginning of this video, I deal with all things finance, one of which is taxes. I had one client's tax return last year that had $230,000 in revenue, but showed that they paid $22,000 in interest to the banks on the loans they had. That's 6% of their revenue just going to pay the banks for the privilege of having loans and credit cards. That's kind of crazy if you ask me. The last way people give excess money to the banks is by not shopping for the best price when purchasing goods. This results in the person paying a higher interchange, which is usually passed on to the customer by the merchant in some way, shape, or form. So given all these things, how do you actually beat the banks? Simple. Make smart spending choices, actively manage your money, and improve your credit score so you get the best rates out there when financing your purchases. And with that, my friends, it's a wrap. If you have a question that you would like us to answer in a future episode, you can send it to questions@makemymoneymakesense.com. That's questions@makemymoneymakesense.com. Also, if you found value in this episode, please give it a thumbs up and feel free to share it with your friends. So like I say at the end of every episode, it's been fun, it's been real. I'm Jared Rogers, and until we meet again, let's all continue to mind my money, and I will see you all next Monday. Take care.